This is TradeFlow News, bringing you relevant news and insights from around the world. TradeFlow News, enabling trade for SMEs and economies worldwide.
These are some of the key topics that we will be looking into in today's program.
First, let's take a look at the overnight headlines which are impacting the commodity markets.
The U.S. will not renew a temporary license that widely eased sanctions on Venezuela's oil and gas sector unless progress is made by President Nicolas Maduro on commitments for free and fair elections this year, a State Department spokesperson said on Monday, 3 days before the license is to expire. The U.S. has been concerned about Venezuela's electoral process and what it sees as Maduro's failure to meet his main promises for the July 28 presidential elections. Absent progress by Maduro and his representatives in terms of implementing the roadmap's provisions, the United States will not renew the license when it expires on April 18, 2024, the spokesperson said.
Oil steadied on Tuesday with support from data showing China's economy grew faster than expected and Middle East tensions, but weighed by concern that U.S. interest rates may stay higher for longer and reduce demand. Official data from China showed gross domestic product in the world's biggest oil importer grew 5.3% in the first quarter, year-on-year, comfortably beating analysts' expectations. Brent futures for June delivery rose 7 cents, or 0.1%, to $90.17 a barrel by 08:01 GMT. U.S. crude for May was up 6 cents, or 0.1%, to $85.47.
Moving on to the top news in the energy sector.
China's oil refinery throughput rose in March as refiners stepped up runs amid signs of a tentative economic recovery in the world's second-largest consumer of crude. Total refinery throughput was 63.78 million metric tons, data from the National Bureau of Statistics showed on Tuesday. That was equivalent to 15.09 million barrels per day, BPD, up from 14.45 million in the January to February period. Run rates were 1.3% higher than the figure of 14.9 million barrels of oil per day last March, a record at the time, as refiners stockpiled fuel ahead of scheduled maintenance.
China's coal output fell 4.2% in March, Statistics Bureau data showed on Tuesday, as miners cut back production on lower demand from power generators and ample inventories of the fuel-limited stockpiling. China produced 399.33 million metric tons of coal last month, the National Bureau of Statistics said on Tuesday. That brought output in the first quarter of the year to 1.11 billion tons, down 4.1% compared with the same period last year. Domestic coal prices fell in March on oversupply and weak demand from marginal consumers in the steel and cement sectors as property development lags in China. Next, we have the top news in metal markets. Aluminium stocks in London Metal Exchange-approved warehouses are expected to slide in coming months as new bans on Russian-origin metal exclude material produced before April 13, market participants said, potentially pushing LME prices higher. By contrast, more Russian metal heading for China is likely to weigh on prices in Shanghai, which fell on Monday after more than 2 weeks of gains. The U.S. and Britain on Friday banned the 147-year-old LME from allowing Russian aluminium, copper and nickel produced from April 13 to be delivered into its warehouses, a move aimed at shrinking Russian government export revenues that help pay for its war with Ukraine.
China's crude steel output in March fell 7.8% from a year earlier as steelmakers cut production amid weaker-than-expected demand and growing inventories, but the decline was somewhat less than forecast. The world's largest steel producer manufactured 88.27 million metric tons of crude steel last month, data from the National Bureau of Statistics showed on Tuesday. That represents an average daily output of about 2.85 million tons, versus 2.8 million tons over January to February and 3.09 million tons in March 2023.
We will now look at the top news in the agricultural sector.
Russia and Ukraine negotiated for 2 months with Turkey on a deal to ensure the safety of shipping in the Black Sea and reached agreement on a text that was to be announced by Ankara, but Kyiv suddenly pulled out, 4 people familiar with the matter told Reuters. The negotiations were mediated by Turkey after nudging by the United Nations, according to the sources who spoke to Reuters on condition of anonymity due to the sensitivity of such talks. A deal was reached in March to ensure the safety of merchant shipping in the Black Sea, and though Ukraine did not want to sign it formally, Kyiv gave its assent for Turkish President Tayyip Erdogan to announce it on March 30, the day before critical regional elections, the sources said.
That is all for today's news on commodity markets. Stay tuned to TradeFlow News as we continue to provide you with more updates. We also invite you to follow us on Twitter at TradeFlow News, which allows you to watch our program on your mobile device or desktop to receive information from there.